silent partnership, and a limited liability partnership, or sometimes called a professional liability partnership. So we have three different versions of a partnership. Which one of the partnership versions has full limited liability protection? It's a trick question. None of them, right? No matter what kind of partnership you put together, at some level, at least one of the partners is going to have full unlimited liability because they have management authority. And so that's one of the problems with a partnership model, regardless of which version you look at. There's always at some level going to be this unlimited liability component, so your personal assets are at risk. So again, we're working our way down the chart here. So next, let's talk about corporations. That's the next form of business structure. And I'm going to start with the liability side and the management side and how they're structured for now, and then we'll talk about the differences between S Corps and C Corps. So when we talk about the corporate model, it's fundamentally different than partnership idea. The corporate model, this is true for both an S Corp and a C Corp. And this will also depend on the size of the business and all that, how they're structured. But typical small business corporate model, you have the owners who are the shareholders. So we have shareholder number 1 and then shareholder number 2. Each of them has 50%. Okay? So again, this could be a farm or a medical clinic or any kind of business you can think of. So the shareholders are the owners. They put money in to the corporation, and in return they get stock. So there are different kinds of stock, which I won't get into too much here, but a share of stock is an ownership interest in a corporation. So if I go buy Microsoft stock on my E-Trade account, technically I'm an owner of Microsoft, albeit a very small one, relatively speaking. So the owners are the shareholders, and their ownership percentage will be based upon the number of shares they hold as opposed to how many shares are outstanding. So in this case, if we have 50-50 shareholders, they each have the same number of shares of stock. Okay? Now, as the owners, they will get that profit percentage distribution that we talked about earlier. And if it's an S Corp or a C Corp, depending, they'll pay tax on that. As a corporate model, as the shareholders, there is a liability barrier right here, in this way as well. So that if there are claims against the corporation that go beyond the value of the corporation, their personal assets are shielded from liability. They may lose the money that they put in. Just like back in the dot-com era, I had a whole bunch of different kinds of stocks, and back then, you throw money at the ground and it would explode, and then the next day it would be worth nothing, kind of like crypto in a way. So you can buy shares of stock, and it may go way up in value or it may go to nothing. That's just the risk you take. But your personal assets are shielded because you're a shareholder. Now, as a shareholder, you don't really have any management authority. Just like I actually own some Microsoft stock, that doesn't mean I can go up to Redmond, Washington and start ordering people around because I have 100 shares of stock. I'm going to get laughed at and probably put in jail if I start pounding on the door. Yes, I'm an owner, but I don't have any management authority. My only management ability as a shareholder is to vote the number of shares that I have to elect the board of directors. So that's our first layer of management in a corporate model. So every year you have an annual shareholders meeting, and the shareholders, in this case there are 2 of them, are going to vote for who will be on the board of directors. And guess who they're going to vote for? Themselves. So we'll have 2 people on the board of directors, each shareholder. So you have different roles that you play in a corporation. one-person corporation, like myself, I'm an S corporation, just me, I'm the only owner. I have employees, but I'm the only owner. So I'm the only person on the board of directors. I'm a shareholder and I am the board of directors, one person. That's really common in small business. Typically in a small business, if you have more than 3 owners, then the board of directors will be a minimum of 3 people, or 5, or 7, an odd number. That way you can have a majority vote. Okay, so the board of directors is the first layer of management authority. And this again will depend on the size of the corporation, but basically the board of directors set the major policies. They're not necessarily involved in the day-to-day operations. And again, this will depend on the size of the corporation. For me, it's just me, I'm involved in everything. But for Microsoft, the board of directors, they're not down there selling computers and writing code or anything. They're on the board of directors setting major policy issues, and then it's delegated downstream to lower level management. So typical in a small business, the board of directors will then appoint the officers. So that's the next layer of management. So typically you're going to have a president, a vice president, a secretary, and a treasurer. In Oregon, to have a corporation, you have to have a president, secretary, and a treasurer. Now sometimes you will also have perhaps a middle layer of officers, perhaps a CEO, a CFO, a COO, CLO, CTO. These are optional. So chief executive officer, chief financial officer, chief operations officer, chief legal officer, chief technology officer, whatever you want to come up with. This structure will all be set forth in the bylaws, which are like the constitution of the corporation. I'm not going to get into more detail on the bylaws, again, it's another class. So highest level of management authority, board of directors, they will then appoint the officers, and then the officers will be in charge of the employees and managers down the line. Okay? So now, when we talk about liability, there's the liability shield for the shareholders, but there's also a form of liability protection like this that helps insulate the managers as well, to a degree. And what I mean by that is, okay, so you're a 2-person corporation, you have 2 people on the board of directors, one of them is going to be the president, the other one's going to be probably the vice president, and then maybe one will be secretary as well, and one will be treasurer as well. They split that. Or perhaps they'll have family members do that. So the idea is, remember in a partnership, the role as a general partner, the management role, you have unlimited liability. So like in a limited partnership, you're either a limited partner or a general partner. If you have management authority, you have unlimited liability. Same thing in an LLP. In the corporate model, this is the idea behind a corporation. The corporation itself is considered to be a separate legal entity distinct from the owners. In a partnership, the partners are still they're their own entity that are joining together in the partnership. So the partnership is not technically a separate entity apart from the owners themselves. Corporation is a whole different idea. So this is the concept. The technical term is a juridical entity. Don't worry about that. But this is the idea that you can have a paper person, a fictional person, so to speak. Now what I mean by that is, in law we have separate types of entities. So an entity in terms of a human being, a human entity, that's all of us. Anybody here a cyborg? No, not yet, okay. So we're all a separate legal entity. And what I mean by that is, as an entity, As a human, you can own property in your name. You can, if you get harmed, you can sue for the injuries you received in your name. If you do something wrong, you can be sued. You can go into debt. But that ownership of assets and obligations and debt are yours. So I'm not responsible for your debt unless I've agreed in writing to be as a guarantor. Corporation is separate from the people. So the debt and the lawsuit, the assets, etc., are all held by the corporation as an entity. Now, what is a corporation? Literally, it's a piece of paper. Literally. Articles of incorporation. So the loan for purchase of a building would be in the name of the corporation, not of the owners. If you have a lawsuit, it's against the corporation, not necessarily against the owners, unless they're the ones that also did something wrong, like driving the truck. So that's where we get this idea of full limited liability. And the idea is, unlike a partnership where the partners are deemed to be working together as individuals, a corporation is a whole separate entity of itself. So any lawsuits or debt are against the entity, not the people, so to speak. All right. So let's talk about S Corps versus C Corps. Now I put here these arrows. I need to redo this chart one of these days, and when I do, I'll move the C Corp over here and put the S Corp here. And the reason why is, in terms of evolution of entities, C corporations, or what we call a C Corp, are very old. I mean, again, a corporate model has been around since ancient Greece, the Byzantine Empire, I mean, thousands of years ago. C Corp and S Corps are U.S. terms, and this comes from the tax code, corporate tax code. So a C corporation is subject to corporate tax under Chapter C of the corporate tax code. An S corporation is subchapter S of the corporate tax code. That's where we get the S and the C, okay? So I mean, if you go to Europe or whatever, the distinction is really not important. But so here's the idea. C corporations, as I said, have been around a long time. And they're very advantageous from a liabilities structure that you have limited liability. The problem with a C Corp, of course, is you have that double tax problem. Now, in a big company, it's not as much of an issue, but in a small company, including a one-person situation, you don't want to be subject to that double tax. You're the only owner. Or if it's a family-run business or just a few owners, you don't want to have that tax problem. So just think about this for a minute. Before S corporations existed, and LLCs did not exist either yet, S corporations have been around since I want to say 85 or 80, I think it was 1986 is when they came into being. And the idea behind an S corporation, before we had S corporations, let's say it was just you, one person running a farm. What were your options? You could be a sole proprietor, just you, one person. You can't be a partnership because you have to have a partner. Or you could be a C Corp. You had two choices. So if you wanted to have limited liability, you couldn't be a sole proprietor. If you wanted to have limited liability, then you had to be a C Corp, and then you're subject to double tax. So it was a burden back, up to the 80s, and that was one of the reasons behind creating S corporations, was to help benefit small business, and especially small family-run business. All right, so now let's say we have the siblings that are running the farm. There are 4 of them that inherited the farm. Before we had S corps and LLCs. So you're going to be a partnership now, or a C Corp. Again, the problem with the partnership models, every single one of them is not so good for a family farm. Because the siblings all want to vote, so they're going to have general partnership unlimited liability. The only way to get limited liability and still be able to vote is to be a C Corp, and now you got to pay double tax. So it hurt family farms and family-run restaurants and everything else. So the idea in the 80s was to create a new form of an entity, the S corporation, which is for small corporations. And the idea was, let's give the advantage of a limited liability like you have in a C corp, but the single tax characteristics of the others. The single tax. And that's where the idea of an S corporation came into being, to benefit and promote small and family-run businesses. So let's take a look at some of the nuances there. Page 84. Okay, so an S corporation, that clock is not right. No corporate level tax. It is a pass-through. The profits flow down to the owners, and then they pay tax on the profits at their ownership level, like we talked about earlier. That's one of the benefits. You don't have that double tax. However, the trade-off, limited to 100 shareholders. It used to be 25 shareholders. Actually, I think for a while it was only 10. But it's now been raised to 100 shareholders. You can go above that if it's all family, but that's pretty rare. So if you're going to be a publicly traded company, you can't be an S corp. You only have 100 shareholders, not 1 million. So you're not going to see publicly traded S corporations. That's not the intent or the purpose of an S corp. Okay, so it's going to be a small business. Most S, I don't know what the average is, kind of should look that up sometime, but I would say probably the average number of shareholders nationwide for an S corp is probably less than 10. Maybe less than 5, just because it's usually for small business. You do have the limited liability like you do for the C corp, limited liability. Typically a fiscal year must be the calendar year. Fiscal year is your accounting year. In a C corp, you can have it different than the calendar year. There are some exceptions to that, though. But here's the next one. Only human shareholders. As opposed to a C corp that can have a non-human shareholder. What is that? Right? E.T.? Now, here's what I mean by that. A C corp can own a C corp. Microsoft can own shares of stock in Pfizer. That's fine. Or a pension plan, right? Retirement plans, they own corporate stock market. Or an LLC can own a C corp. So you can have an LLC that owns shares of Microsoft stock. That's fine. But it's not the other way around. A C corp cannot own an S corp. That's what I mean by a non-human shareholder. So the shareholders cannot be a business entity. So you can't have a C corp or a pension and profit sharing plan or a union pension plan or other type of entities owning an S corp. It's intended to be for small business. So the shareholders have to meet qualifications. You have to be a human or what's called a qualified subchapter S corp trust for estate planning. And there's some other exceptions and restrictions. So the idea is we're not going to have corporations owning S corps. And the reason for that is because it's a pass-through entity, you're not paying corporate tax, you could set up an S corp owning an S corp and basically never pay tax in a way. And then you can only have one class of stock, which is called common stock in an S corp. In a C corp, you can have different kinds of stock, preferred stock, Class A, Class B, voting and non-voting, convertible stock that's convertible to debt or vice versa. I mean, you can be very creative. Can't do that in an S corp. Everybody has to have the same type of stock. And again, you don't want people, this is set up for small business and to try to keep it simple. So the main thing I want you to know about the S corp, again, it's intended to benefit small business and it's not going to be for large business activity. Very common. I'm a big fan of S corporations myself. As I said, that's what I am in my law practice. My wife's a dentist. She's an S corporation. So it's very useful, very useful. So that brings us to LLCs. All right? So LLC stands for Limited Liability Company, Limited Liability Company. And they are the newest, not necessarily greatest, but newest form of business organization type that we have. And these started to show up in the mid-1990s. And they're adopted from one state to the next over the years, and now pretty much every state, as far as I'm aware, has them. So the idea of an LLC is to create a form of business organization that is very, very flexible. And basically the idea, and this gets a bit confusing, so I'll try and simplify it. But basically the idea was, let's create a form of organization format that allows you to basically pick and choose which of these different factors that you like and roll it all up into whatever kind of structure you want to have. So it's kind of like Play-Doh, right? You can mold it into whatever shape you want. So I could mold it into a horse shape, and then I could turn it into an airplane, or I could mold it into whatever. So in some ways it gets kind of confusing. The IRS for a while didn't know what to do with them, but the law is getting more stable now. So basically the way I look at an LLC is essentially it is so flexible, but it's still going to break down into one of 4 different versions to keep it simple. And I'll show you what I mean. So the idea of an LLC, first of all, is you're going to have the same liability protection as a corporation. But the idea is we're going to allow, if you want to keep it very simple, like a sole proprietorship. It's just you and one person. It's called a single member LLC. So when I look at LLCs, I'm going to reduce the paper here. So let's say again we have 2 owners. An owner of an LLC is called a member. It's like you're a member of a club or something. So you're a member, you're the owner, you put money in, and you get a percentage back, depending on how it's set up. And I say you put money in, it could be other, you could put land, equipment, trademarks and copyrights, or it could be you're just contributing labor or expertise, like you're a builder. It's real common. LLCs are used a lot in development. So you have the landowner, they put the land in, and then you have the construction contractor who's a building expert. They do all the building. They sell the houses that they built, and then they split the profits, that kind of thing. So LLC, the owners are members. And just like in a corporation, you have that liability protection, same as a corporation basically. Although not exactly the same, but pretty darn close. Enough for this class. Now, in an LLC, this is how I view LLCs. There are basically 4 different versions of an LLC. An LLC, in a way, is kind of like an avatar. You know, when you go online, you create your little character or whatever, and you can make it be whatever you want it to be. That's kind of what an LLC is. So when I break them down into 4 basic categories. The sole proprietorship model, the general partnership model, the limited partnership model, and the corporate model. So what I mean by that is sole proprietorship model is called a single, one person, single member owner, one owner LLC. Very, very, very common. In fact, that's one of the preferred ways to do business now. If you're a one-person situation, don't be a sole proprietorship. Register as a single member LLC. It's actually quite simple. And so if you look at our chart, one of the advantages of a sole proprietor is you have all the management authority. Single tax, so you don't have to pay that corporate tax. Not a lot of formality, but you do have to file with the Secretary of State. But unlike a sole proprietorship, you have a limited liability. So it's basically a sole proprietorship with limited liability. So for tax purposes, You're treated like a sole proprietor, you file your individual tax return. Pretty straightforward way to do business. So that's what I mean by the sole proprietorship, or a single member LLC, okay? Single member LLC. All right, the next version is like a general partnership where people vote their percentage, right? This is called a member managed LLC. So again, like the general partnership, you have, all partners have the ability to vote their percentage. You have single tax, not a lot of formality, pretty straightforward, more formality than a general partnership because you've got to register as an LLC. But unlike a general partnership, limited liability. So one of the good things about a general partnership is everybody gets to vote. The bad thing is that unlimited liability problem. But now you can get rid of that by being an LLC. The members all get a vote, whatever percentage ownership they have. Now the vote may be a majority vote, or sometimes it may require a supermajority vote, like 67%, or maybe it's unanimous voting. Like for example, a family farm. This is what we use for family farms all the time. So I have 4 siblings that own the farm. We're going to be an LLC, member managed, like a general partnership, they all get a vote now. But now they have limited liability. So we have the advantages of the simplicity in voting of a general partnership without that unlimited liability problem. Very common. Next version is the limited partnership model. And again, this is where you have a manager. So this is called a manager-managed LLC. So this is the apartment building model. So remember, in the apartment building, we have the limited partners who cannot engage in any kind of management, and we have the manager who manages, but they have unlimited liability. So now we set up an LLC, but the limited partners can have management authority as well. And usually what will happen is they will appoint the general manager who will have day-to-day operational authority, pay the bills, paint, do all the maintenance. But for big ticket questions, they will retain voting authority. So whether to sell the building or not, whether to refinance, whether to put a new roof on, whatever stipulations you want to have. So kind of the day-to-day will be the manager, but the big ticket items will still be voted on by the investors. Can't do that in a limited partnership model. But it's very efficient. So you have the limited liability for everybody now, not just the investors. And then we have the corporate model of an LLC. And that is also a form of a manager-managed LLC. But now you have like a board of directors and officers, if you want to, you don't have to. But this is becoming very popular, and this gets a little bit beyond the level of this class, but a real popular method I'm seeing in the last few years is a single or 2 or 3 person LLC that elects to be treated as an S corporation. You're still an LLC, but you pretend you're an S corporation rather than a partnership. And there's some tax benefits there, which I won't go into in this class. It gets really detailed. Or if you wanted to, you could be a C Corp LLC. You could either be an S Corp or a C Corp LLC. Not really common, but theoretically, LLC might want to be a C corporation if they wanted to hold money back and not distribute it out as profit, so they can build up cash to either acquire other companies or to buy other properties or do research and development or whatever. You want to build up cash reserves. So that is a LLC treated as a C corporation instead of a partnership. Now again, this gets really detailed, way more detailed than I'll test you on. But I just want you to kind of have a general idea. because LLCs can be very confusing. That's why I break it down into these 4 types. Now this is my own personal thing. I'm a practicing attorney, is what I do, and this is kind of how I do it in my own practice when I'm advising my clients. These are the 4 basic models. Okay, for the test, simple, keep it simple. Really all I want you to know is what I have highlighted up here. So these first 2 lines, which ones have limited, which ones are unlimited liability. And remember, whenever you see a general partnership role, always think unlimited liability. A general partner never has liability protection, ever. And I want you to know these 2 boxes down here. In a general partnership, all partners can manage, it is signed. And in a limited partnership, only the general partner can manage. The limited partners have to remain silent. They cannot engage in management activity, or they lose that status. Okay, so in the book, I'm not going to test you on any of this, but I do have the forms that we use in the real world to file with the Secretary of State, just so you can kind of see what they look like. Again, this will not be on the test. It's a whole different class where we actually do the forms. But here's that assumed business name I was talking about if you want to have that register a business name. It's on page 93. And if you want to be a corporation, this is the form you would use for that. And again, you would file this with the Secretary of State in the state of Oregon, up here at the top, right here, Corporation Division. And if you want to be limited liability partnership, you'll file this form. LLC, limited liability company, it's this form. And these are all online now. The forms are slightly different than what's in here. They've updated them a little bit, but just to give you an idea what they look like. So, that's enough on that